Welcome to BondTV. First in private capital news.
Good afternoon and welcome to another episode of BondTV. I'm Leslie Clark, and we're taking a deeper look into the evolving financial landscape as we start thinking about 2026. If you've been refreshing rate announcements like their college football playoff scores, good news. There was action this week. Bad news, it's still complicated. So let's decode what the world's central banks just did, why it matters, and what small and mid-sized businesses should consider right now. Spoiler, this isn't 2009, and that's actually okay. First stop, the Federal Reserve. The Fed cut rates another 25 basis points, the third straight, bringing the federal funds target range down to between 3.5% and 3.75%. The vote was split 9-3 in a hawkish cut that tries to balance still elevated inflation with a softer labor market. Chair Jerome Powell emphasized there's no risk-free path and the Fed's now nearer to neutral. They are no longer flooring the brake or the gas. The Fed also resumed buying Treasury bills to keep reserves ample. Wonky, but it helps market clumming. If you're thinking, great, mortgage rates will dive, hold that thought. Long-term rates drive mortgages, not the Fed's overnight rate. The cut won't directly shave your 30-year fix tomorrow. Up north, the Bank of Canada held at 2.25% and repeated that policy is about the right level given inflation near 2%. And a surprisingly strong Q3 GDP at 2.6% annualized, with unemployment down to 6.5%. The tone, resilient, but uncertain, especially with trade volatility. Governor Tiff Macklem's message, inflation pressures are contained and the bank stands ready if the outlook changes, but for now, steady as she goes. Across the Atlantic, the European Central Bank held rates at 2.0%. Eurozone inflation is hovering just above target, and officials keep saying policy is in a good place. In other words, we're in the watchful waiting era. The Bank of England. It cut 25 basis points to 3.75%, with Governor Bailey cautioning that further cuts will be a closer call. Meanwhile, the Bank of Japan is going the other way with a December hike to 0.75%. Governor Uda says Japan is closer to sustained 2% inflation as normalization continues after decades of ultra-loose policy. So yes, policy rates have come down from 2023 peaks in the US and Canada and are on hold in the euro area, likely nudging lower in the UK and edging higher in Japan. But channel your inner Howard Marks. Rates aren't historically high, they are just higher than your recent memory. The abnormal period was the 2009 to 2021 near-zero world. And with Powell signaling, near neutral, and empirical evidence reminding everyone the neutral rate may be higher than many think, don't bank on a free fall in rates from here. What does all this mean if you're running a small or mid-sized business? Financing conditions have improved at the short end, but SME lending globally has stayed restrictive and skewed shorter term. Translation, banks are friendlier, but they are still asking lots of questions and prefer lines and short tenors. Private credit keeps competing hard on deals, and spreads have tightened. Bid news on price, mixed news on covenants. And higher base rates altered the game. Let's get tactical. 5 plays to call in your 2026 team huddle for growth and transition. 1. Barbell your debt maturities. Blend a short-term revolving line to ride near-term rate easing and manage working capital with a 3 to 5 year term piece to lock in before term premia creep higher again. Avoid going all short or all long, keep optionality. 2. Refi and reprice opportunistically. If your floating rate loans repriced at peak base rates, revisit them now. Lenders are active. Spreads in some credit tiers tightened versus 2024. A modest base rate decline plus tighter spread equals real savings, even if it's not 2010 cheap. 3. Consider asset-backed and leasing for capex. With banks preferring collateral and shorter tenors, asset-based finance and leasing can be effective for equipment or fleet upgrades, spreading cash impact and de-risking your balance sheet. 4. Diversify lenders, bank plus private credit. In a market where the Fed is near neutral and Bank of Canada is pausing, diversifying sources can improve terms. Banks for working capital, private credit for bespoke growth or acquisition facilities. Each has different speed, diligence, and covenant styles. Mix to taste. 5. Strengthen data and collateral story. Lenders love predictability. Tighten cash conversion cycles, show contracted revenue, and highlight collateral values. In some markets, digital credit scoring and public-private programs are improving access. Use them. For ownership transitions or acquisitions, think structure, not just price. Earnouts and seller notes can bridge valuation gaps while reducing upfront cash and debt service, especially if growth is tariff noise sensitive. Pair with a modest unitranche or senior plus mezz stack to keep covenants livable. Holding company revolvers sized to working capital plus asset-backed capex lines can smooth integrations without overlevering operating companies. If you're counting on rate tailwinds alone, Powell says don't. Mortgages and long-end yields won't mechanically mirror a Fed cut. Underwrite deals to today's rates with upside if the curve cooperates. Bottom line, central banks are easing where they can, pausing where they should, and tightening where they must. Your playbook is less about predicting the next 25 basis points and more about creating flexibility, balanced maturities, diversified lenders, smart covenants, and disciplined cash. Oh, and if you catch yourself wishing for 0% rates again, remember Howard Marks' line, "The free money era was the abnormality." Normal feels weird, only because we got used to weird. Thank you for joining us on another episode of Bond Capital TV. Whether you're an operator, investor, or advisor, staying informed is your best defense in uncertain times. We hope you found today's insights valuable. I'm Leslie Clark for Bond Capital, and we look forward to seeing you next time.